Passive income and foreign investments can seem like a golden ticket to financial freedom. Yes, until the Italian tax authorities knock on your door. So let's see how the same income streams can be either a blessing or a burden, depending on how you manage them. As an expat in Italy, one of the most common misconceptions is that passive income and foreign investments are treated the same as in your home country. This is a basic assumption. But our Italian tax system, by definition, is default, a complex system, and has strict rules regarding worldwide income, worldwide asset taxations, foreign held assets. While the right strategy can make a lot of sense in your home country, can make these income streams highly profitable in your own country, ignoring compliance or misunderstanding the Italian rules can quickly turn everything that worked there into a financial disaster here in Italy. Let's meet a name that I really like, Emma, okay? A Canadian living in Florence. And she owns a portfolio of dividend-paying stocks in the US. Her annual, on the yearly basis, passive income from these investments is $250,000. Emma consulted an international tax advisor before moving to Italy, and together they reviewed the tax treaties. So Canada, the US, and Italy, they have the tax treaties in place to prevent the dual taxation. So Emma ensured that her dividends were taxed at a reduced tax rate in the US, up to 15% at most. She filed the RW form. So Emma had to disclose her foreign investments through the Italian mandatory RW filing framework for the wealth tax purposes. So this to make sure that she avoided penalties for undeclared assets for wealth tax purposes, the 0.2%. But at the same time, she took advantage, after reviewing everything, of the flat tax regime. Emma, at that time, qualified for the Italian flat tax regime for new residents. At that time, it was 100,000 flat. So she paid a fixed 100,000 flat on a yearly basis on the foreign income with no reporting whatsoever. So this capped her liability, making her investment highly profitable compared to the regular rates. So what is the outcome here? By planning her move carefully, comparing two tax regimes, Emma kept her US investments almost intact, and she minimized at the same time her tax burden in Italy. So in this case, it's a blessing because it's a joint combination of being wealthy, having passive income, and the opportunity of the 100,000 for high net worth individuals. So her annual after-tax income was way more than 100,000, okay? According to the Italian tax rate, the IRPEF incremental regimes. So this would allow her to enjoy her life in Florence without worrying about compliance or extra taxes. So when passive income turns into liability. Another situation, okay? James retired from work, British citizen, moved to Sicily after inheriting a rental property in London. The property generates around 30,000 per year rental income. And James assumed he could continue paying taxes only in the UK as he had done before moving for years. So what went wrong here? Well, worldwide income rules have been ignored. As a tax resident of Italy, James was required to declare his rental income to Italy, even though the property was in the UK. The higher tax rates. Italy has different rental income rates, progressive rates, with the top rate reaching 43%. So even after deducting allowable expenses, James owed approximately 10,000 in Italian taxes on top of the 5,000 already paid in the UK. But most and foremost, non-compliance penalties. And James, failing to file the RW framework, now has to pay another 6,000 penalty for not declaring foreign assets for the wealth tax purposes. So his passive income quickly became a liability. His property became a liability. So between the higher tax rates, penalties, interest, he lost nearly 60% of his rental income in Italy in the first year. is there a way for you to leverage the right tax scheme? Well, maybe. Sophia, okay, an American digital nomad. She earns 100,000 yearly basis through loyalties, from ebook, investments, cryptocurrencies, everything. She moved to Italy under the regime forfettario, the simplified tax regime that allows you, for small businesses and self-employed, to pay a 5% substitute tax. So this is how she made her taxes work for her. With the low tax rates of the regime forfettario, Sofia capped for 5 years the income tax to 5%. And then, of course, it could jump to 15%. But let's see how she will go with that. Then she got the exemption for foreign income. The royalties from no Italian services were considered non-subject for the Italian VAT purposes. So that has reduced her overall tax burden. And now, a very smart move about the crypto planning. By working with a financial advisor, in this case, Sophia structured her cryptocurrency portfolio and investments to minimize taxable events in Italy on the cash basis principle, such as, for example, capital gains. So her effective defensive tax strategy brought a tax rate in Italy significantly lower than in the US. So basically, that was the perfect way to allow her fiscal position to move to Italy and reinvest in her business and grow her passive income streams without any damage for her portfolio. What happens when you mismanage your foreign investments? And they happen. Another real-life scenario, Luca, an American dual citizen. He maintained a brokerage account in the US after moving to Rome. Over 5 years, he accumulated 200,000 in unrealized gains. What went wrong in this case? He failed to declare. Luca never reported his brokerage account in the RW framework, so missing the wealth tax obligation, believing that, unrealized gains didn't count as taxable income. Well, yes, maybe the gains, but not the brokerage account. He forgot about the capital gain tax. Eventually, when Luca sold his stocks, he triggered a taxable event in Italy. But unlike the US, Italy does not have any preferential rates for long-term capital gains, so the flat rate of 26% kicked in, out of the blue. And then penalties. His undeclared account led to 10,000 euros fine plus 5,000 interest. So he made, roughly speaking, 200,000 profit, reduced to 140,000 after taxes and penalties, 60,000 in taxes and penalties. Poor planning turned a really nice gain into a much smaller outcome. So, what's the lesson here? Always, I would love starts with this one. Seek professional guidance early on. Passive income, investment abroad, foreign investment in general, can be profitable. Okay, that's for sure. But only if you understand the tax implications here in Italy, with Italy and your home country. Always speak with an international tax advisor before making financial decisions, even before you're moving. Rule number 2, understand reporting obligations. Do not fail to report foreign investments, even those generated almost no income. Those can result in steep penalties too. And why not leverage tax regimes? Italy nowadays, December 2024, offers several tax incentives for new residents, such as flat tax regime, regime forfettario. Knowing which one applies to you is so important. And be aware of the dual taxation agreement. While tax reliefs help you reduce the dual taxation, they do not eliminate that. They do not get rid of the credit entirely. They do not get rid of the debit entirely. Proper planning ensures you do not overpay, so never leave anything on the table. Make sure that you can find the best way to split the bill and pay what is due. Nothing more, nothing less. And remember this, compliance is not negotiable. Ignoring, for whatever reason, Italian strict reporting and taxation can turn profitable ideas, companies, businesses, passive income, distributions into financial disasters. Do not trust superficial advice. Get into details. Passive income and foreign investments can unlock, and this is what I wish you to, unlock a world of financial freedom, especially for expats living in Italy. However, navigating our system without expert advice from a fiscal and financial point of view is like walking a financial tightrope. One misstep can lead to devastating consequences, and I know for sure I met a lot of people that made this mistake. If you're considering a move to Italy in the future or in the next few days, already living here with the foreign income streams, the best investment you can make is in a proper tax planning. It's not about saving money or getting rich. It's about securing your financial future and protecting your peace of mind. And yes, your wallet too.